this month's edition of On Track. It's the 27th of July as I record this, and we've got all the financial news right up to date and performances and numbers up to the end of June. Lots happening as always, and on again, off again on a few topics, including the Middle East. Just when we thought it was maybe over, it looks like it's coming back, and I'll talk about that a bit more, along with some AI updates and some updates on the tax changes in Australia and the effect that's having on the property market as well as covering all our usual stuff. But before I do, quickly, this monthly recording is for clients of McGregor Wealth Management. To anyone else who's watching, feel free to enjoy it, but please don't do anything based on what I say here without getting advice that's particular to your own circumstances. So let's dive in. Like I said, on again, off again. The Iran war has flared up again, and the best way to look at it is through the oil price. Bottom left-hand corner, you can see the original war spiked up. This is the price of Brent crude oil, up to $110, $120, up and down. Then it looked like it was dropping all the way, as we talked about the last few months, then bang, back up to about $100 and just below there at the moment. We'll see what that happens. It really is the indicator of where the market's going. Now, what that means is if that lingers longer, we're back to the same discussions about inflation. The inflation gets stickier. We just seen inflation drop down to about 3.5% in the US, which was good. But if this lingers, that may drift up again, and that may lead to interest rate rises. Interest rates steady, both across the US and Australia. But 10-year bond rates, which give an indication, have bumped up again. The share market sort of, since this round started, has sort of wobbled down and sideways, not by much. It's just going sideways as it works out what to focus on next. There's lots going on, and I'll unpack some of that. Now, we've seen property markets weaken, predominantly in Melbourne and Sydney, but it's really mixed around the country. And it's a combination of causes: higher interest rates and uncertainty. Property investors hate uncertainty and they tend to pause, which slows the market down. I'm going to talk more about some of those things. On the rates front, no real changes of anything substantially there. Like I said, US inflation dropping down. Our Aussie number doesn't come out for another 4 days, but potentially that's down, but that'll be no Reserve Bank's going to act on that while the oil price is heading up. And we run the risk of having to bump up interest rates a bit more, but we'll see what happens. Good numbers for term deposits still, although they have dropped a fraction. Macquarie's dropped their 1-year rate to 5.2, and mortgages still a good rate in the low sixes, with occasional 5.9s, but most people about 6.25 that we're seeing. Really solid results to the end of June. Of course, the end of June marks the end of the financial year, and that these numbers have come in really good. So our high growth down the bottom at 12.23, growth at 11, balanced at 9.3. These rank in the top groups of returns if you compare it to industry super funds and others. So another pleasing year with results across the board, and particularly you'll see the last 3 months has been a comeback. We might see some of that given up. So 3 months returns there in the high growth of about 8.48 as the war steadied, and we saw the AI stocks head back. We'll see what happens depending on whether that continues. I'll talk about some of the long-term drivers in a minute and the shorter-term focuses that are driving this. But solid returns, no change to our dial. We still have that set to a 9, so just a little bit expensive. And the markets have certainly delivered on profits, and that's prompted us to bring that back. And if profits continued, and if markets drop much, we'd probably bring it back to an 8. But we'll see what happens. You can see there the usual wall of worry, and we're in another valley at the moment. We'll see if that drops or whether it turns into just a minor one. At the moment, that drop from the war, less than 12%, so it doesn't count in our range here. But we see these as so normal as we get through all these valleys of fear. Now we're back. We're starting another one that's potentially fear of inflation. We'll see what happens. All of them are overcome in the long run, though. It's just a matter of when. So I want to talk today a bit about a couple of things. AI valuations, you would have heard the news, and depending on who you hear it from, it's really sensationalized. You'll hear things like AI is going to change the world, um, and yeah, everyone's going to lose their jobs, all sorts of things like that. But the reality is no one knows exactly how this transpires. In past booms, so booms of technology. As we've brought in new technology, whether that be the production line, whether that be from plows to tractors, whether it be to electricity, more jobs have been created as well. Will this be the first boom where less jobs are created? No one knows. The research we're doing at the moment shows certainly for the next 3 years, there's more jobs being created by AI, including training, including implementing in big companies and things like that are being lost. Most of the job losses so far are in coding. There are other areas, and coding being computer program, other areas will happen, but yeah, we'll see. So, but let's have a look at the dollars, because we've got this argument between the bulls and the bears, but what they don't dispute is the numbers, and they're huge. So 27 trillion has been added to the market value of AI related companies since late 2022. 27 trillion. That is absolutely huge. Now, the combined 2026 capital expenditure of the four largest hyperscalers, that's Google and the like, 725 billion. So they've spent 725 billion on deploying AI, data centers, chips in building the computing capacity that allows the large language models to work and to create the applications that rely on AI. It's a massive spend. It's not, you can use a similar analogy to when the roads were built in the 1890s in the US, and when roads were built through the 50s and 60s, the highway system around the States, and eventually the .com where the internet was built. But this is big. At the moment, the cash flow from those hyperscalers, so think Google, think OpenAI, which is ChatGPT, and these mega companies are spending 93% of their cash flow on capital expenditure. Absolutely massive. But the interesting thing is that's going to flip over, and they're now going to start borrowing to do that capital expenditure. Not always unusual, but it changes the risk profile. It's about 1.5 trillion, according to Morgan Stanley, that'll be spent over the next 3 years, and of new debt that will be raised. So while they've been using cash that they've produced internally, they're now going to start producing debt, which does change the risk profile. And let's have a look at the bull case and the bear case. So the case that says the increase in valuation is fair on the left here is that revenue is being recognised now, not promised. NVIDIA data center revenue of 75.2 billion in May quarter, up 92% a year ago. That's real revenue. So the revenue is real. The demand is broadening. You've got the non-hyperscaler buyers. So that's the cloud, that's what they call the application layer. So picture the large learning models, ChatGPT, Claude, Anthropic, these things build the engine, which is the large language model. The computing power needs the data centers, needs the energy for that. And then people build AI applications on top of that, which is the application layer. So it's compounding fast. 25 billion annualized. Anthropic has a 47 billion run rate in May. That means their revenue is up to 47 billion. Keep in mind, they had almost zero revenue a few years ago, both from standing start. So combined, you're looking at about 70 billion of revenue. This came from almost nothing a couple of years ago. Quite phenomenal. That revenue is real. Goldman Sachs have framed that as 2 to 3% of GDP currently being spent in this area. It is comparable to that railroads boom and the autos boom historically, and set to reach the capital expenditure side of it. Keep in mind there's revenue coming in, but they're massively spending money to build the infrastructure, and that's set to reach about 1.1 trillion in 2027. Now, this is good for the economy. Anyone spending on the economy, that is good. It goes into the global economy, that provides jobs, and it circulates the economy. The question here is whether these companies will be able to recoup their investment on a company basis. So that is if the valuations are justified. At the moment, the logic is that there's risk asymmetry. So there's a danger of underinvesting and losing the race in the war for AI. So they're spending hard. That's all of them, from Facebook to Google to all these hyperscalers, which is just another name for saying the massive companies that exist, the Magnificent Seven and other now, like Anthropic, like OpenAI, that run Claude and ChatGPT. So the case against, so the bears are saying the CapEx is outrunning sales by about 46%, which is wider than the 32% gap in the telecom cycle in 2001. I don't think they're like for like, personally. I think this is way bigger of a technology change than that. Time will tell, and I could be totally wrong here. Maybe it's not. Valuations at the moment sit at about 25 times EBITDA, which is high. It's above where the telecoms traded before the dot-com peak. But once again, there's real revenue here. One of the earmarks of the dot-com bubble back in the early 2000s was a lack of profit, whereas we're seeing profit at the moment from these new hyperscalers, and visible CapEx underestimates the commitment. So there's a whole bunch of things that are signed but not yet commenced on data centers. There remains a big question as to whether they're going to build too many data centers. It's causing issues around the world for people that don't want these data centers in their backyard. And these are just big data centers that are full of computers churning away and running AI. It's quite amazing. They need a lot of energy. So ironically, yeah, that's one of the big issues. They need water, they need energy. And it's just become a massive, massive business. But as I said before, the funding mix has shifted from equity to debt, which means if things went bad, if returns don't go through, as well as companies collapsing, it also has a massive impact on banks. Watch this space. It's totally unclear. These arguments for and against are both valid. The market will fight it out and see what actually works. And yeah, so we'll see. We'll see how that goes. But I just wanted to give you an update on that. In our exciting life, boring money segment today, I'm looking once again at private credit, and we had a fascinating month where, on the one hand, we had Australian Super saying it's going to double its private credit exposure over the next 4 years to 20 billion. And that means, yeah, in its balance fund, it's going to lift it from about 1.5%, just over, to about 3 to 5%. And the rationale is, as its members retire, they need more income, not just capital growth. So it's an interesting analysis, and not so much the issue, but on the other side, we've got issues in private credit. So from Fitch's, the default rate in private credit is 6% to April 26, and it's holding there. We're seeing more and more defaults. They're not huge, but these are where loans haven't been repaid, which affects if you're getting a 7% return on private credit, but you write off 6% of the value, you effectively only had a 1% return, and so on. So we'll see how that goes. There's an index called the Pro Skewers Index, which is the amount of redemption. So redemptions from unlisted private credits have overtaken the fundraising. So that means there's more people trying to pull money out than putting money in. So a lot of them just freeze redemptions. People can't get their money out. So private credit is not liquid. But the big issue is not being marked to market. So in the public debt space, if there's rumours of a bond not being paid, the value of that drops on the market, and it is reflected in those investors' balance sheets. So if a super fund owns a bond and the value of the bond drops, the value of the super fund drops. The challenge here is that the private credit investments held predominantly in industry super fund, but in other places as well, they're not being marked to market. So they're hiding the losses. And that's the bit that worries me the most. ASIC is massively aware of this. They've put the local sector, that's the industry super funds, on notice ahead of 30 June valuations, and they're telling them not to wait for formal defaults before marking assets down. Now, private credit assets around the world, the listed ones, are being discounted, but we're not seeing that in the unlisted space in the industry super funds. So be very wary about investing in industry super funds whose assets, and particularly if you're putting in big licks, particularly if the assets may be still at old prices and not discounted for the stuff that's happening there. And this is the problem in three parts. it's impossible for us, it's impossible for anyone to understand the losses that might be in any private credit investments. That makes it almost impossible for us to recommend private credit as an investment in the super funds, because we just don't know where it's really priced. And we've seen this from property investments, infrastructure, and other things. And this is why industry super funds have underperformed over the last 3 years with the hangover of some of those. And this may be creating another area where they may underperform coming up. The challenge with these things, they're treated like fixed income liquid investments, but they're just not liquid. Blackstone, one of the biggest private credit funds in the world, got 3.8 billion of redemption requests. So if these things start to lose confidence, people almost create this run. They ask for their money back. Now, even if they just lock up and don't pay them the money back, it creates lack of confidence in the industry. But normally where there's smoke, there's fire in these things. And it's probable that there's been some lower quality lending in the private lending space, which will float to the surface eventually. How long, who knows? And that's all because so much money has gone into this, people start to lower their deal quality. In Australia, Australian private credit is concentrated massively in the property market, right when there's no real increase and where there's development issues, and that has a potential to be big losses if that leads to development failures and this type of thing, where private credit has predominantly lent to them. So not saying there's going to be a disaster, but be very, very careful when investing in private credit or investing in super funds that have significant private credit, not only private credit, but private equity. So let's get into the normal numbers. You'll see in 10-year bond yields on the right-hand side, you'll see the little spike, and this is a few days ago, this chart now, so it's gone up even higher. So rates are sneaking up again at the 10-year bond. That's an indication that bond markets are worried about inflation, and that's an indication that short-term rates may go up. We're now seeing the yield curve in both Australia and the US at the highest it's been last 12 months. That means interest rates are higher at every segment than they have been in the last 12 months. So let's have a look now at, and I'll probably drop this into July, but this was the analysis that I started at the start of the year. And in green, I'm saying, yep, these things have come to path. We've had good growth around the world. We've had that AI capex cycle that I've just talked about today. That's providing growth for the world. We did not get falling interest rates. We actually got higher interest rates because of the war in Iran and the rise of energy prices. So that one didn't come to play. We've still got government spending too much money, and while that's bad for their debt and longer term interest rate, it's good for short term GDP. And balance sheets from corporates and households to some degree, not too bad, and emerging markets are doing well. In terms of the headwinds, that was the risks we identified facing the markets at the start of 26. We had the high valuations, and we're still in this race. Haven't marked this either green or red. There's that question mark over whether valuations are going to prove to be too high or whether they're going to prove to be too cheap. Watch that space. Inflation is sticky. This one has come to pass. There hasn't been, despite US debt and other government debts around the world staying high, there hasn't been a reckoning on that. So that's a positive that hasn't hit that headwind. The private credit one I've talked about is starting to go a little bit orange. We'll see. But the real issue here is whether that has any contagion. That means if private credit started to fail, does it cause grief in other areas, like banks, etc., which have now moved a little bit into that private credit space, or in some cases, the banks are funding private credit providers. So we'll see if that contagion does emerge or doesn't. And we've certainly had trade and tariff tensions, and just this week tariffs are back. People are kind of ignoring it because we've heard it all before, but I think they've just announced a 12% tariff on all goods from Australia. We'll see where that lands. I don't think anyone's listening daily and reacting to it because it just seems to be more of the same, and the market's kind of pricing it in for now. The black swans, the ones that haven't happened, the AI bubble boom, no sovereign debt crisis. Central banks possibly force back into rate hikes is one of them. That's right on the cusp at the moment. We may see that. We saw a couple of rate hikes, but it's really if the US has to start hiking. And once again, that systematic stress in the private the shadow banking private credit world emerges. And a shock in the geopolitical, other than the one that we're seeing in terms of the ones that have been on the table, which is, as well as Iran, is still Israel, Hamas, and Ukraine, Russia are still lingering away. And the white swan, as if none of these things to come to pass, and AI actually causes a boom in all companies, which is one of the possibilities over the next few years. As always, when the world is uncertain, it just reinforces our key tactics of diversification, avoiding punting on single issues, always having some powder dry for opportunity and liquidity, and maintaining that long-term focus with some mid-term awareness, which is exactly what we do. I won't pause on there. And as I said, no change to the dial this month. We've left that at a 9. So market's just in that fair to a little bit expensive range. Private credit, just re-emphasizing, when we talk about the ways people mess up their longer term investments, one of them is with illiquidity, where you can't actually sell an asset. So even that appeal of the high interest rates, it means that we can't see. I talked about last month the iceberg, which you can't see the risk of that going broke until it actually goes broke. Whereas in markets, you actually see it as the market adjusts the prices. And once again, chasing performance. I actually saw some ads this month for 24% returns. So these things are incredibly misleading, and they're made to look like term deposits or guaranteed returns. They're made to appeal to naive investors, and just really dangerous. And there's a certain gravity in investments, and anything that's promising that much is highly unlikely to play out, and often ends with major capital losses. So be careful out there. Behavioral biases, recency bias. Recency bias is just this bias where we're so focused on whatever's happening right now that we think it's way more important than it actually is compared to the normal longer term things. We're seeing that on a few fronts at the moment, including tax changes. The market will settle, although there are some dramas in that. I'll talk about that in a minute when I get to the property section. But current news always seems more important than it is, just because it's right in our face. It's the recency that does that. And as usual, one of the secrets, just reminding in terms of our pillars here, but in terms of managing investor behavior, which is really the biggest impact on your long-term financial returns, avoiding bad decisions is actually as important, if not way more important, than making the good decisions, or equally important at best. So you'll see we've entered kind of a choppy period this year. So 1 year still solid 7% return for Aussie shares to the end of June, slightly under the long-term averages, but highly respectable. And that is including dividends. The chart looks choppy, and you'll see that little sideways towards the end as we go back into this potential war period. You'll note BHP is the biggest company in Australia now. So pretty much every Aussie share portfolio will contain just over 10% of BHP, with Commonwealth Bank now at second, but still pretty close to 10% as well. US shares, different outlook. This is VTS, so it's held in our core portfolios, and it's the US market. Once again, about 7.53% for the month. Negative, quite a bit of negative in the June month, and some of that's continued into July as the oil prices start to tick up again. But you'll see top of the ladder in terms of company investments in that index is Nvidia, the chip supplier. But these are the listed hyperscalers, Nvidia, Apple, Microsoft. But you've got the unlisted ones there now in terms of OpenAI and Anthropic, which will list at some stage, possibly in the next year. And that's going to make even more of a concentration at the top in the US on the tech stocks / hyperscalers. Global leaders, much the same story, top 100 companies in the world, but it's predominantly US based, except for Samsung there, but the rest are all US based. So a bit of a repeat there. But 1 year, 25%, because this is when we just have the big companies and we don't have the small companies. So those big companies dominating performance again last year and delivering a good return. US small caps have come back with a vengeance. So they were lagging. If you look at the bottom right-hand corner, you could see that for 3 or 4 years they went sideways after they'd had a stellar decade before then. And then all of a sudden they're back up this year and seen a 19% return. You've got to love diversification because you just pick this up because we maintain these through the good and the bad, and we rebalance as we go through. Emerging markets even more so, 37% return for the year. And once again, if you look from sort of 2020 through to 2024, almost no return, and then bang, up it goes. And during that time, we were buying into them to keep our holding stable. So we enjoyed the performance that comes from that rebalancing. Gold went the opposite way. So it's still a spectacular year at 22%, but at one stage that was closer to 60. And you'll see bottom right-hand corner, it's given up a lot of that run, being the blue dots there, and come back from its peak. This is GOLD, but come back from just over $70 down to just below 55. Probably a healthy correction. We still love having gold in the portfolio, just for all the reasons we talk about here. It's an insurance policy compared to the rest of the portfolio. It's a currency hedge, as we think the US dollar has a long-term trend down because of their debt problems. So we like having gold in the portfolio. Let's go into the property world, and I'm just going to do an update on where some of the budget stuff is in. So the government rushed through the legislation. So negative gearing and capital gains tax legislation is in. So that means from the ability to negative gear stops from 1st of July 2027 for established residential property. You can still do it for new property, so new builds, and any existing properties you've got before 12th of May 26, that will stay. But from there, any losses are quarantined to future gains. So if you make a loss on a property, so you can still negative gear, you just won't get a tax break for it, and you'll carry those losses forward to offset against future gains. So it's a timing issue. So you won't get an immediate tax benefit. Capital gains tax, we lose the 50% discount to be replaced by indexation and a 30% minimum tax rate. So you can pay higher. That's for individuals, trusts, and partnerships. So there was no capital gains tax in company. Capital gains in companies are taxed just as income at the company tax rate. Companies become more attractive as an investment vehicle. And as we sit down with all of you, we'll be reviewing your structures. Now, grandfathering here, like I said, anything held before 12th of May is exempt, but the capital gains tax reform, even though it's grandfathered, the new capital gains tax process starts from 1st of July 27 for all assets, even assets already held, even assets from pre-85. So I don't really call that grandfathering. And it creates this complex thing where you'll have to calculate a gain up to 1st of July 27 when you sell, and beyond that using the new method of indexation. It's going to be more work for accountants. They don't love doing this work. It's a grudge spend from their clients, but it's just got more complicated, which is frustrating. You can argue whether it's good, bad, or indifferent, but it just adds to complexity, which is not great. Like we said, new builds are carved out here, and commercial property and shares are not affected, so you can still negative gear those. Now, one thing that I talked about, and actually I've got a slide coming up, I'll talk about that in a minute, but here's what the markets have done, and it's mixed. National prices are down slightly, and you'll see headlines here. There is no average market in Australia. You've got some markets that are up, like Perth, still up 23%, but Melbourne and Sydney are heading down. But that's only prices. Rents are actually up 6% since this was announced. That's not good for the property market. It shows that none of this is going to solve quickly the supply-demand issue, and that the supply response is not enough to solve the problem, and ultimately that's what's needed. And there's some sting in the tail. So as I talked about last month, the ability to borrow and buy residential property in super funds was wiped out in a grubby deal that the government did with the Greens to rush through the other legislation. Now, they haven't thought about this, and it's going to have real consequences that are the exact opposite of what they're trying to achieve. This article in a broking magazine explains it fairly well. So they've warned that the government's crackdown on this is going to strip demand from developments. So let me explain. When a developer decides they're going to develop a block of units, they go to the bank to borrow, and their ability to borrow depends on what's called pre-sales, where people have bought off the plan. And a big chunk of that market is for this. Yeah, a big chunk of those pre-sales come from self-managed super funds. So all of a sudden, that market disappears completely. That means developers will have much more trouble getting those pre-sales, which probably means less developments will go ahead. Less developments going ahead means less properties being built. Now, that'll be a short-term impact, whether it's filled by investments outside, but effectively, 20% of super fund lending was for developments off the plan. That's about 1,500 loans a year. That's about 1,500 properties a year. That's not insubstantial. Our fixed income advisors realm brought this to our attention at last week's investment committee meeting, and it's a real drag. And the government just has not thought this through. So yeah, that's going to do the exact opposite of what they're supposedly trying to do. Now you'll see the mixed movements here. So at the top you got Perth, they're absolutely flying at 21%, but you'll see the downtick, particularly in Sydney and Melbourne, where they're down now over, well, they're heading down. They're still up slightly over the 12 months, but it's such a mixed market. I've seen one commentator out there saying annualized, that represents a 10% fall. It's kind of dumb to annualize a 1% move. And this is what the markets have done. And yes, they've fallen, but they've fallen, and I'll get to those numbers in a minute. So for the 3 months to May, you can see Melbourne and Sydney are down 2.3%, down 2.1%. Now, if you annualize that, you get that they're falling at an annual rate of 10%, but it's totally misleading. So be wary of what you're reading. Maybe they go down that much, maybe they don't, but you'll see the divergence in the numbers as well. So in the last 3 months, Perth up 4.8, Darwin up 5.2, Brisbane solid at 3.4%, as is Adelaide, and Adelaide quite strong in the last month as well. No real change to interest rates. Like I said, in that 5.3 to 6.44 range, so up to 6.5. No savers in fixed rates. They're kind of all pretty flat. You can lock in a 5-year rate at 6.54. Keep in mind, there's always two reasons to lock in interest rates. One is because you're predicting that rates might go up. That's very hard to do. It's incredibly hard to predict well. But the other reason to lock in a rate is just to know your cash flow. So if you're going into a geared arrangement, it's nice sometimes to know that you can afford the interest rate for the next 5 years just by locking it in. So they're the two reasons, and both valid. Property clock, no real changes. We see the top of the clock fairly crowded, including Sunshine Coast, Gold Coast, places like regional New South Wales, Brisbane and Adelaide approaching the top there as well, in that selling window for those that are looking to sell. Now, this is even more important at the moment if you're considering holding properties post the tax changes, because with the 30% minimum tax coming in, that means the old strategy that we had for many people of waiting until you're retired, selling the property, having the capital gains tax 50% discount, and added to zero income because you're now retired, now falls flat. You've now got a 30% minimum tax. So even if you're not earning any other income, you'll have a 30% tax on the bit after 1st of July 27. So it won't make a big difference for people selling in the next 4 or 5 years. You'll be required to have a valuation as at the 1st of June 27. I suspect there'll be some shenanigans in the way people do that. We will talk to you all individually about the best strategy for you. So always love looking at the long term here. The shape of this graph is slightly misleading because it's a linear scale. So 200 to 400 looks the same as 400 to 600, even though 400 to 800 is the next double. If this was a log scale, it'd be rather flat and boring, of just steadily going up over that period. And keep in mind, from 1980 to 2026, the main driver of property prices going up was interest rates coming down from 13 to 15% down to 6%, below that for a while. So that was what kicked a lot of that growth over that period. If we just assume interest rates go sideways, there's less big gain from property. Still can go up, but not by the massive amounts there. And it would only be if interest rates went down a lot that they would have a positive input into that. Now, that's just one factor. Supply and demand is massively driving that at the moment with a shortage on the supply side. So in wrapping up, as always, investing best done as part of a real plan. We just absolutely fundamentally believe that the best financial decisions are made as part of a real plan. That's one that's based on you and your goals and what's important to you, with your portfolio and investments designed to meet those goals. We take a long-term view, as I said, with a medium-term, short to medium-term awareness, and then we apply the basic principles that have been proven timelessly: diversification, smart asset allocation, and enough liquidity. Low cost index funds for most markets, unless there's a reason not to. We've always got a couple of those. Protecting against short-term volatility with reserves and dollar cost averaging and rebalancing regularly, which is the only free lunch in investing. Only 3 ways to lose money, and as always, our clients just don't do it. Panicking and sell, having to sell, and not properly diversified. I thank you, as always, for listening and giving up half an hour or so of your time. I hope it's helpful. As always, give us any feedback on what you want to hear more of, less of, or anything at all when it comes to this, and we'll see you soon. Have a great day.